Picture this. You wake up without the piercing sound of an alarm. There's no rush to get ready, no long commute, and no looming deadlines. Instead, you step outside, feel the breeze, and enjoy a leisurely cup of coffee, knowing your bills are paid, your future is secure, and your financial freedom is intact. This isn't just a fantasy. It's a lifestyle made possible by living off dividends. Dividend investing isn't just another strategy tossed around by financial advisors. It's a proven way to create wealth, generate passive income, and build a retirement that doesn't require you to sell off your assets. Instead of working for money, your money works for you, relentlessly, consistently, and efficiently. In this video, we're diving deep into the mechanics, strategies, and secrets of dividend investing. By the end, you'll understand why it could be the ultimate retirement plan. Whether you're a beginner or someone already investing, there's valuable knowledge here that could completely transform your financial trajectory. What are dividends? Let's start with the fundamentals. A dividend is a portion of a company's profits paid to shareholders. When you own a dividend-paying stock, you're essentially a co-owner of that company, and dividends are your share of the company's earnings. These payments might seem modest at first glance, but over time, they can accumulate into a substantial income stream, particularly when reinvested to harness the power of compound growth. Think of dividends as the fruit of a money tree you plant. Every quarter or year, that tree produces fruit in the form of cash payouts. As long as the company remains profitable and continues to grow, your tree keeps producing. The best part? You don't need to chop down the tree to enjoy its benefits. Unlike selling stocks, where you lose part of your portfolio, dividends allow you to live off the yield while preserving your original investment. These payouts can occur monthly, quarterly, or annually, depending on the company's policies. Some companies have even built reputations for consistently paying and increasing their dividends for decades. Over time, this steady stream of income makes dividend investing a cornerstone for anyone seeking long-term financial independence and a reliable retirement plan. Why dividend investing is perfect for retirement. Retirement isn't just about stopping work. It's about ensuring that you have the financial stability to live the life you want without worrying about running out of money. Dividend investing aligns perfectly with this vision, offering several unique advantages that make it one of the most reliable strategies for retirement planning. 1. Passive income stream. The beauty of dividends lies in their passive nature. When you're retired, your goal is to generate income without lifting a finger. Dividends provide exactly that, a consistent and predictable income stream. Whether the stock market is booming or crashing, solid dividend-paying companies tend to maintain their payouts, creating a sense of financial security. This means you're not reliant on selling assets during a market downturn to fund your lifestyle, which can be disastrous. 2. Preservation of capital. A key concern in retirement is protecting your nest egg. Unlike growth stocks that depend on appreciation, dividend-paying stocks often belong to mature, stable companies. These businesses are typically less volatile, making them a safer bet for retirees who prioritize preserving their principal. By living off the dividends rather than selling stocks, you can maintain the core of your investment portfolio for decades, leaving a legacy for your heirs, or simply ensuring you never run out of money. 3. Inflation protection. Inflation is the silent killer of purchasing power, and ignoring it can erode your savings over time. However, many companies that pay dividends also regularly increase their payouts. This means your income grows along with inflation, preserving your purchasing power. A portfolio built around dividend growth stocks can act as a hedge against rising costs, ensuring that your lifestyle remains comfortable as prices increase. 4. Tax advantages. In many jurisdictions, dividends enjoy preferential tax treatment. While regular income from wages or traditional retirement accounts is often taxed at higher rates, dividends may be taxed at lower rates, or even qualify for tax exemptions in certain cases. For retirees, this can mean keeping a larger share of your income, stretching your dollars further and giving you more financial freedom. How to start building a dividend portfolio. Building a portfolio capable of sustaining your retirement through dividends doesn't happen overnight. It requires careful planning, strategic investment, and a disciplined approach. Let's walk through the steps you need to take to create a powerful dividend-paying portfolio that will serve you for years to come. 1. Set clear income goals. The first step is to determine how much annual income you'll need to cover your retirement expenses. Be realistic but thorough. Factor in everything from housing and healthcare to travel and entertainment. Once you have a target, you can calculate the size of the portfolio required to achieve it. For example, if you need $60,000 annually and plan to invest in stocks with an average dividend yield of 4%, you'll need a portfolio worth approximately $1.5 million. This might sound daunting, but don't let the big numbers intimidate you. Remember, you don't have to reach this goal all at once. Consistent contributions and compounding growth will get you there over time. 2. Focus on high-quality companies. Not all dividend stocks are created equal. Some companies pay dividends as a marketing gimmick, while others have built reputations on their reliability and growth. Your job is to identify high-quality companies with a long history of dividend payments and increases. 10+ years is ideal. A low payout ratio, typically below 60%, ensuring the company has room to sustain or grow its dividend. Strong fundamentals, including consistent revenue, profitability, and manageable debt levels. These companies are often referred to as dividend aristocrats or dividend kings. Examples include Procter & Gamble, Johnson & Johnson, and Coca-Cola. These businesses operate in sectors that are essential to everyday life, making them more resilient to economic downturns. 3. Diversify across sectors. One of the cardinal rules of investing is diversification, and dividend portfolios are no exception. By spreading your investments across different sectors, you reduce the risk of a downturn in any single industry wiping out your income. Popular sectors for dividend investors include utilities. These companies provide essential services like electricity and water, making their revenues and dividends relatively stable. Healthcare. With aging populations worldwide, healthcare companies remain strong performers with consistent dividend growth. Consumer staples. These companies sell everyday necessities like food and household goods, which people buy regardless of economic conditions. 4. Reinvest dividends early on. When you're still in the accumulation phase, reinvesting your dividends can supercharge your portfolio growth. This is the power of compounding at its finest. Your dividends buy more shares, which then generate even more dividends, creating a snowball effect. Many brokerages offer dividend reinvestment plans, DRIPs, which automate this process, making it easier for you to stay on track. 5. Monitor and adjust regularly. Dividend investing isn't a set-it-and-forget-it strategy. You need to periodically review your portfolio to ensure your investments remain aligned with your goals. Keep an eye out for red flags like dividend cuts, deteriorating fundamentals, or excessive debt, and be prepared to make changes if necessary. The power of dividend growth stocks. While high yields may grab attention, the real magic lies in dividend growth stocks, companies that not only pay dividends but increase them consistently over time. These stocks offer a 1-2 punch. They provide immediate income and protect against inflation by boosting payouts year after year. For instance, imagine investing $10,000 in a stock with a 3% dividend yield. If the company increases its dividend by 8% annually, your yield on cost will rise dramatically over the years. After 10 years, you could be earning a 6.5% yield on your original investment. This combination of growth and compounding can transform a modest portfolio into a financial powerhouse.